Good morning and welcome to the Bills, Bears, and the Bell Morning edition of the Deep Dive.
Good morning.
If you're trying to find the signal in all this market noise right now,
Yep.
Caught between this heavy geopolitical fear and a whole wave of economic data coming at us, well, you're definitely in the right place.
Absolutely. We spent the last, 48 hours really digging through everything, looking at the futures, the calendar, the pre-market action,
Yeah.
trying to give you that shortcut.
Cut through the noise.
Exactly. Our goal today is just that. Cut through the overload, pinpoint the real conflict that's driving sentiment this week. It's a critical one.
Okay, let's dig in then. It feels like we're seeing this strange split, doesn't it? Between, abstract market signals and what's actually happening on the ground.
That's a great way to put it. On one hand, you have this almost primal fear in the market. Geopolitics, the threat of stagflation may be rearing its head again, driven by these trade war rumblings. That's the abstract side.
The fear side.
Right. And that fear, it's about to run headfirst into, reality, tangible reality. Starting Tuesday, we get CPI, the big inflation number.
And earnings.
And the huge wave of Q3 earnings, starting with the big U.S. banks. It's this collision, this clash that's going to set the market's path. Break down or rally hard, the stakes feel really high.
You can feel it in the volatility, can't you? It's
Yeah.
already pricing in some big moves.
Okay, so what kicked all this off? The immediate trigger for this really sharp risk-off move, it was sudden.
Yeah, it came out of nowhere, it seemed.
Exactly. An unexpected ramp-up in U.S.-China trade tensions, specifically that renewed tariff threat from the U.S. president. It just, caught investors totally flat-footed.
And the market reaction wasn't subtle, was it?
Not at all. Immediate punishing. The Dow just tumbled nearly 900 points in the last session. S&P 500 had its biggest drop since, April?
Wow.
And the important thing here, I think, is that this wasn't a slow bleed. It was like a fundamental repricing of global growth, almost overnight, based purely on a geopolitical comment.
I thought what came after was just as revealing. Our sources pointed out that, after that massive drop, these tiny little rebounds happened.
Right.
And they were tied to these almost throwaway comments suggesting, oh, it'll all be fine.
Yeah, that tells you everything, doesn't it? It shows a complete lack of conviction. We're absolutely in what you'd call a headline-driven regime.
What does that mean exactly for people listening?
Well, it means the investors who look at the long-term picture, fundamentals, balance sheets, economic cycles, they're basically sitting on the sidelines.
Hands off.
Totally. And the algorithms, the short-term momentum traders, they're jumping on every soundbite, every technical level. And that leads to these huge swings because the real money, the fundamental crowd, isn't there to stabilize things. They won't play in the chaos. Liquidity just dries up.
And the best way to measure that chaos is the fear gauge itself, right? The VIX.
Precisely.
Yeah.
The CBOE volatility index. This is where it gets really, really interesting.
How so? What did it do?
It just surged more than 31%, jumped right up to 21.66.
Okay, big jump. But what does that mean? Why is a VIX jump like that so significant?
Well, look, it's not just a number on a screen, it's a mechanism. Yes, technically it means the market expects much higher volatility in the S&P 500 over the next 30 days. But the so what is much deeper.
Okay, tell us about that deeper mechanism. Why does getting above, say, 20 on the VIX actually change things operationally?
It means there's this sudden, massive scramble for portfolio insurance, put options, basically.
So hedging gets way more expensive.
Exactly. But it's also a feedback loop, a powerful one. Lots of big institutions, prime brokers, they have risk limits tied directly to volatility levels, like the VIX. So when the VIX spikes like that, their internal models just scream de-risk. They have to cut leverage. They face constraints on how they allocate capital. This kills market depth, sucks out liquidity.
And that makes any subsequent selling even worse.
Precisely. It amplifies the down moves. It creates this self-feeding wave of selling, even if there's no new bad news. A high VIX basically limits the market's shock absorbers.
So if you're running a risk parity fund or some systematic strategy, that high VIX forces you to sell, making the panic worse. It's like a technical time bomb.
That's a perfect description, a technical time bomb.
Okay, so we've got the high-level fear measured by the VIX. Let's drill down into the actual damage report in the futures market. Yeah. Was this fear spread evenly across U.S. stocks?
Oh, definitely not. The damage report is pretty clear about who the market thinks gets hit hardest by renewed trade worries. NASDAQ 100 futures took the biggest hit, down over 3.5%, 3.56% to be exact.
Wow. That sensitivity in tech, is that just about tariffs on like finished iPhones, or is it something deeper, more structural?
It's much more structural, I'd argue. Tech relies on these incredibly complex global supply chains, right, spanning everywhere. But the real nerve here is the critical component.
Like rare earths.
Exactly. Rare earth metals, specialized manufacturing processes, a lot of that is dominated by China. So a trade fight isn't just about the cost of the finished gadget. It's about potentially cutting off the supply of the stuff needed to make the chips inside the gadget. That threatens the whole production pipeline.
Okay, that makes sense. Meanwhile, the broader market, S&P 500 futures, down 2.71%, Dow futures pointing to another drop of nearly 900 points, about 1.9%. Still getting hammered, just maybe not quite as bad as tech.
Right. But what's also crucial, don't forget the small caps. The Russell 2000, which tracks smaller, more U.S.-focused companies, that was down over 3% too.
So it's not just the big multinationals people are worried about.
No. That's the key takeaway there. The market isn't just pricing in tariff impacts on exporters. It's worried the whole geopolitical mess is bad enough to actually slow down the entire U.S. economy, hitting domestic confidence, domestic spending. That's a bigger fear.
And this fear just spread like wildfire globally, right? Instantly.
Instantly. A global transmission of risk-off sentiment. Asian markets got hit hard. Hong Kong's Hang Seng plunged, 3.49%. Just brutal.
Yeah.
Then Europe opened sharply lower. Germany's DAX down 1.5%, UK's FTSE down nearly 1%. It confirms that investors everywhere are looking at this political instability and collectively marking down global growth prospects.
So with all this money flying out of stocks globally, we get the classic flight to safety. Where did it go? Where did that scared money run?
Well, the main destination was the traditional safe havens, especially precious metals. Gold and silver.
Why metals specifically?
It's kind of a multi-layered thing. Partly it's a straight hedge against the geopolitical risk, right? Uncertainty drives people to gold. But it's also playing on longer-term inflation fears, potential currency debasement, given all the central bank stimulus over the years.
Okay, let's get specific. Gold. It blew right through $4,000 an ounce. That's a huge psychological level.
Phenomenal run, isn't it? And it's now trading around $4,071. That's its 8th straight week of gains. That tells you this isn't just a one-day panic. It feels like a sustained macro shift. Investors are bracing for something more than just a trade spat.
And silver.
Silver had an even wilder ride, surged nearly 5%. Silver plays that dual-role industrial metal, but also a safe haven, a move that big suggests not just safe haven buying, but maybe some short covering, too. People betting against it getting squeezed out.
Makes sense. Now, quick point. We're seeing huge volume in gold. Why aren't we talking about U.S. Treasuries with the same intensity? Isn't that the usual go-to safe haven?
That's a really crucial point for listeners today. It's technical. The U.S. bond market is closed Columbus Day.
Ah, right.
So while Treasuries are absolutely the #1 flight to quality asset, normally that door is temporarily shut. And that's funneling even more of that scared money into the precious metals complex right now.
So gold is soaking up even more of the fear because the bond market is offline.
Exactly. Once the bond market reopens, you'd expect some of that capital to flow into treasuries, maybe taking a little pressure off gold. But for this moment, gold and silver are bearing the full brunt of that risk-off positioning.
Okay, let's zoom in now. From the big macro fear down to the micro-level impact. Looking at the pre-market action, the volume, you can really see where the market's focusing its anxiety and also where it's finding these little pockets of uncorrelated opportunity, what we call idiosyncratic alpha.
Right. And let's start right at ground zero of this trade anxiety. The semiconductor sector, the chip stocks, they are absolutely the canary in the coal mine for this trade war.
We're seeing the big names. NVIDIA down almost 5%, Intel down nearly 4% in pre-market. The market's aggressively pricing in bad news for the whole industry.
It is. But the real tell, the deepest sign of conviction here, isn't just looking at NVDA or INTC. It's looking at the specialized tools traders use for hedging and betting. We need to talk about the Direction Daily Semiconductor Bear 3X Shares ETF, ticker SOXS. SOS.
Okay, explain SOXS for us. It's one of those leveraged inverse ETFs, right?
Exactly. It's designed to give you 3 times the opposite return of the semiconductor index on a daily basis. So basically, it's a weaponized short bet against chip stocks. High conviction stuff.
What's happened with SOXS this morning?
This is fascinating. SOXS has become the single most active security in the entire pre-market, period. Staggering volume, over 469 million shares traded, and the price, rocketed up over 19%.
19%?
Yeah. So this isn't just vague fear. This is a very specific, very well-funded, coordinated bet that the semiconductor industry is going to be the #1 casualty of this trade escalation.
So the market is using SOXS as its weapon of choice to bid against chips because of this specific geopolitical flashpoint.
Right.
What's the underlying fear driving a 19% jump in one session?
It comes back to those rare earth metals we talked about, that supply chain choke point.
Yeah.
The U.S. tech sector is hugely reliant on China for processing and supplying these critical elements needed for advanced manufacturing.
Right.
The explicit fear, the fear driving that SOXS volume, is that China could, and maybe will, restrict those exports as retaliation. That's a structural nightmare for U.S. and allied chipmakers. That massive volume in SOXS, it's the market putting a price tag, a high probability on that specific export restriction actually happening.
Okay, so while that geopolitical wave is crushing tech, we're seeing the exact opposite in a few individual stocks.
Yeah.
That uncorrelated alpha you mentioned. The biggest one today looks like ESS Tech Inc., ticker GWH.
Yeah, GWH is just exploding, up over 143% in the pre-market. It's a dizzying move.
What's the catalyst?
A really significant deal, actually. A landmark pilot project with Salt River Project, SRP, a major utility. They're going to deploy a 50-milliwatt long-duration iron flow battery system from ESS Tech.
Okay, that sounds big. Validation for their battery tech in the booming energy storage space. The market loves a future growth story.
Oh, it absolutely does. And the reaction is pure speculative frenzy. Volume over 277 million shares. But, and this is the crucial warning, the aha moment, for anyone watching, you have this amazing positive tech story clashing violently with the company's underlying financials, which are, frankly, precarious.
Okay, let's pull back that curtain. What do the numbers actually look like for GWH right now?
They're reporting deeply negative gross margins, like staggeringly bad, minus 625.6%.
Wait, minus 600%? What does that even mean?
It means for every dollar of product they sell, they're currently losing over $6 just on the cost of making it. Plus, they're burning through cash, and their liquidity isn't great. Current ratio is only 0.5. The market is just completely ignoring these numbers right now.
So why on earth would anyone pour money into a company losing $6 for every dollar of revenue? That seems insane.
It's a classic bet on the future, not the present. It's about the total addressable market, the TAM, and the technological optionality. Investors are making a higher risk gamble that the long-duration energy storage market is going to be so gigantic, potentially trillions of dollars, that getting this validation from SRP makes the current losses irrelevant.
So they're buying the dream, not the reality.
Exactly. You're buying the potential for revolutionary growth years down the line, and you accept that the current balance sheet doesn't matter. It's pure speculation, high conviction, probably a lot of FOMO, fear of missing out on what could be a huge winner, high risk, high reward defined.
Okay, let's quickly touch on a couple other big movers. Safe and Green Holdings, SGBX, up over 92%, but for a totally different reason.
Yeah, SGBX is interesting. It's all about de-risking. They announced they're back in compliance with all the NASDAQ listing rules, and they did a capital restructuring that significantly reduced the risk of future dilution for shareholders.
So just removing uncertainty was enough.
Sometimes that's all it takes. By getting rid of those known technical risks, like the threat of being delisted, they restored enough confidence to spark this huge relief rally. Sometimes cleaning up the existing mess is more valuable than finding new business.
And lastly, Conexa Sports Technologies, YYAI. Second most active stock, huge volume, over 427 million shares, but it's actually trading down slightly.
And YII really highlights the power of this negative macro overhang, doesn't it? Despite that enormous speculative interest which came from earlier news, like a crypto-related deal, the stock just can't get any lift.
The tide's just too strong going out.
Exactly. The broader trade war fear, the general risk aversion, it's just overwhelming that speculative buying in this low-price name. It shows how much this technical sell-off is dictating individual stock moves right now.
All right, we've covered the immediate jitters, the geopolitical fear, the sectoral stress. Now, let's pivot. Let's talk about the fundamental tests coming this week. This is where that abstract fear meets the hard data, that narrative collision you mentioned.
Right. Because this market fixation on trade headlines could just get completely pushed aside by a new, potentially more powerful story about the domestic economy, and specifically what the Fed is going to do about it. This week sets up a major potential turning point. Could be very volatile midweek.
And the absolute main event, no question, is the Consumer Price Index, CPI, the inflation number.
That's the one. Wednesday, October 15th. It's the single most critical piece of data this week. The consensus forecast is looking for a 0.3% increase month over month for both the main headline number and the core number, which strips out food and energy.
But the headline isn't the whole story, right?
Not at all. It's just the starting point.
Why is CPI so crucial right now? Especially when the Fed kept saying inflation was, transitory for so long.
Because it's the main driver of how the market sees the Fed's interest rate path going forward. The market desperately needs proof that inflation is actually cooling down. And you have to look inside the numbers. The Fed's watching specific components very closely. Service sector inflation, definitely. But the big one is owner's equivalent rent, OER. It's the largest single piece of the CPI calculation, basically measuring housing costs.
Right.
That's been sticky.
Okay, let's game this out. Scenario 1. We get a hot print. Inflation comes in higher than that 0.3% expectation.
And
what happens?
a hot number, especially if it's driven by sticky stuff like OER or services, would instantly bring back those fears of persistent inflation. That forces the Fed towards being more restrictive, more hawkish, higher rates for longer. That's a whole new source of market pain, completely separate from the trade war, and it could crush stocks that rely on cheap borrowing.
Okay, scenario 2. A soft print. Lower than expected inflation.
Well, that gives a sigh of relief on the inflation front, right? Suggests the Fed might pause, maybe even signal a pivot towards easing sooner. That would be good for bonds, good for rate-sensitive stocks. But
there's always a but.
If it's too soft, say, inflation comes in near zero, then it just feeds the other fear, recession. The fear that the trade war is already choking off growth. The market really wants that Goldilocks number. Not too hot, not too cold. Soft enough to calm inflation worries, but strong enough to suggest the economy isn't collapsing.
Got it. And besides CPI, what else are we watching this week to get a read on the economy, especially the consumer? They're like 2/3 of activity, right?
Yep. Two other key inputs. First, retail sales on Thursday. That's a direct measure of actual spending. Are people still buying stuff? The expectation is for a modest 0.4% increase. Any big surprise there, up or down, will move markets.
And second,
the University of Michigan Consumer Sentiment Survey on Friday. This one's really timely. It'll give us the first real glimpse of how these latest trade tensions, the tariff threats, the stock market drop, how that's actually hitting the confidence of the average person.
And connecting all this data back to policy, we've got a ton of Fed officials speaking all week.
A Fed speak barrage, yeah. The market will be hanging on every word from Chair Powell, Governor Bowman, Neil Kashkari, you name it, especially after the CPI data on Wednesday. Any change in tone, any hint of leaning more hawkish, or even just acknowledging that geopolitics is making their job harder, that will ripple through currency and stock markets instantly.
And quickly, the global backdrop.
Yeah, don't forget the IMF and World Bank are having their annual meetings this week. That's where global policymakers talk about these trade issues, the global outlook. Plus, we get key data from overseas China's trade balance, UK unemployment. It helps paint the picture of whether the slowdown fear is global or just a US-centric worry.
Okay, so the economic data gives us forecasts, but earnings season, starting now, that feels like the real-time weather report from the ground. I'd argue the forward-looking comments from CEOs might be even more important than the backward-looking government stats this week.
I completely agree. Earnings reports are the ground truth. They capture what's happening now in a way government data just can't. This guidance, what companies say about the future, it could either completely validate the market's worst fears about demand slowing down or potentially provide a massive contradiction and spark a relief rally.
And that ground truth starts hitting hard on Tuesday with the financials floodgate. The big U.S. banks, JP Morgan, Goldman, Wells Fargo, Citi, BofA, Morgan Stanley, all reporting.
These banks are the ultimate barometer, aren't they? For the U.S. consumer, for corporate America, when they report, you absolutely have to look past the headline EPS number.
Right. What are the key things listeners need to focus on? The deep dive metrics.
Okay, three crucial forward-looking things. First, net interest margin, or N9. This is their core profitability gauge, the difference between what they earn on loans and what they pay out on deposits.
How's that looking?
Well, higher rates generally help banks, but the pressure's building because they have to pay more to keep deposits now. That squeezes the margin. If NIC drops significantly, it signals tough competition or maybe shrinking loan profits.
Okay, number 2.
Loan growth. Simple but powerful. Are businesses and consumers still borrowing? Taking out loans to expand, buy homes, finance projects. If loan growth stalls or shrinks, it points to a broader economic slowdown, people pulling back.
And the third one, You said this one really signals management's own lack of confidence.
Yes. Loan loss provisions. This is absolutely critical. It's the money banks are required, legally, to set aside now for loans they expect might go bad in the future.
So it's their forecast of future defaults.
Exactly. An increase here isn't just accounting. It's management saying, based on our models, we see trouble coming in the next year or 18 months. If guys like Jamie Dimon start significantly boosting these provisions, especially for consumer loans or corporate debt, that is a direct flashing red light that they see credit quality deteriorating. It confirms the market's recession fears in a big way.
So what the CEOs say about credit quality in their commentary will be huge, maybe more than the actual earnings number itself.
Absolutely paramount. Forward guidance from these bank CEOs carries immense weight, more than dozens of analyst reports combined.
Okay, let's shift back to tech for a minute, especially after that semiconductor sell-off we discussed. Two absolute giants are reporting this week, and their guidance has global ripple effects for basically everything electronic.
Right. First up is Taiwan's Semiconductor Manufacturing Co., TSM, the world's biggest, most advanced contract chip maker. Their results, but even more so their guidance, tells you everything about end market demand.
For what kind of products?
Everything. Smartphones, data centers, high-performance computing. TSM makes chips for almost everyone.
So TSM is like the global demand thermometer. If their outlook is weak, it means fewer phones, servers, computers are being bought worldwide.
Precisely. It's a single, unified view of overall electronics demand. A weak forecast from TSM would pour fuel on that bearish trade war fire and validate that big NASDAQ futures drop we saw.
And the other key tech player reporting, ASML Holding.
ASML. They're unique. They are the only company in the world that makes the EUV lithography machines. Extreme ultraviolet. These are the incredibly complex, hugely expensive machines you absolutely need to make the most advanced, cutting-edge chips. ASML sits right at the very top of the semiconductor food chain.
Okay, so what insight does ASML give us that TSM doesn't?
ASML gives us a window into future capital spending. TSM tells us about demand today. ASML tells us what chipmakers like Samsung, Intel, and TSM itself are planning to invest 3-5 years down the road.
So it's about long-term confidence and expansion plans.
Exactly. If ASML's order book looks weak, it means chipmakers are getting nervous and pulling back on big long-term investments. But if their order book is strong, despite all the current fear, that's a massive countersignal. It would suggest the long-term tech demand story is still intact, overriding the short-term geopolitical noise. That would be a powerful bullish sign.
Okay, so let's try to pull all these threads together. What does this mean for you, the listener, trying to make sense of the market this week? It feels like this intense three-way tug of war, right? Geopolitical fear pulling one way, inflation worries pulling another, and corporate reality about to pull back.
That's exactly it. Right now, the path of least resistance still feels lower, driven by that trade fear, the de-risking, the high VIX. But the potential for a sudden, sharp change in direction is incredibly high this week. We're facing a series of almost binary tests.
Let's lay out those two competing scenarios then. The inflection points people need to watch. First, the scenario where the bears are proven right, the bear case confirmation.
Okay, for the bear case to really take hold and push us lower, you probably need 3 things to happen. First, the trade rhetoric heats up again. More tough talk, maybe specific actions threatened or taken against supply chains.
Okay.
Second, that CPI number comes in hotter than expected, forcing the Fed to sound more hawkish, more restrictive.
And third,
disappointing bank earnings. Specifically, what we talked about. A noticeable jump in those loan loss provisions. Banks signaling they see credit problems ahead. If those 3 things line up, more trade fear, higher inflation fear, and confirmation of credit worries from the banks, then you likely see another big structural move down in stocks, both external and internal risks confirmed.
Okay. Conversely, what does the bull case, or at least the stabilization case, look like?
Right. The path where the market finds some stability, that probably needs, first, signs of trade de-escalation. Even just some positive comments about talks resuming could help.
Okay, less noise there.
Second, that CPI number needs to be benign. That Goldilocks print we talked about, soft enough to ease inflation fears, but not so weak it screams recession. And third, and this is critical, resilient bank earnings, especially manageable loan loss provisions, maybe decent NIM trends. Banks showing the consumer is okay, credit risks aren't spiraling.
So if the banks hold up and inflation behaves, that could break the fear cycle.
It could absolutely challenge the current bearish mood. Because if those things happen, that big fear premium baked into stock prices right now could evaporate pretty quickly, leading to a sharp relief rally.
So for our listeners trying to navigate this mess strategically, what are the key actionable takeaways from our deep dive today?
Okay, three main things. First, monitor headline risk. Sounds obvious, but right now, geopolitical news, especially U.S.-China trade talk, is the #1 short-term driver. Stay tuned.
Got it. Second,
Focus on the data inflection points. Wednesday's CPI print and those first bank earnings reports starting Tuesday, those are the first real chances for this market narrative to make a decisive turn. Watch them closely.
and fun.
Identify relative strength and weakness. The semiconductor sector, highlighted by that insane SOXS volume, is clearly a point of vulnerability. Treat it with caution if pressure continues. But on the flip side, remember those individual stories, the uncorrelated alpha plays like GWH or SGBX. They show opportunities exist even when the broader market is scared. Look for those pockets. #tag outro. So wrapping it all up, this is really the week where the market's abstract fears trade wars, stagflation get tested against cold, hard reality, corporate earnings, inflation data. The result of that collision is likely going to set the tone for trading for quite some time, maybe the rest of the quarter.
Absolutely. And then you think about all these connections we've discussed, that VIX spike, the rush into gold, the upcoming CPI number. Here's maybe one last provocative thought for you to chew on. If these geopolitical tensions keep pushing commodity prices like gold and silver higher, like we're seeing with this flight to safety, does that actually make the Federal Reserve's job fighting inflation even harder? Because suddenly they're not just dealing with domestic demand pressures. They might also be facing this new wave of imported inflation driven purely by geopolitical fear pushing up commodity costs. Does that complicate the whole CPI picture, regardless of the initial reading?
That's a profound question. It ties that global fear directly back into the core challenge facing monetary policy right now. A lot to think about. Well, thank you for joining us for this deep dive.
Yes, thanks everyone. We really encourage you to keep exploring these connections, these competing narratives shaping the market. We'll talk to you again soon.